Good afternoon, everyone, and welcome to AIM Virtual 2020. Today's event is the final installment in our three-part virtual series, which was developed to keep our network of AIM members and longtime partners connected to the critical issues affecting our industry during the pandemic. My name is Sanjeev Shah, and I'm a managing director at HarborVest Partners in Boston, and I also happen to be the current AIM board co-chair. On behalf of the entire AIM board, I would like to thank you for joining us, especially if this is your first AIM event. I would also like to take a moment to thank all of our sponsors and partners for making this series possible. Before we get started, I'd like to give a quick overview of today's program, which will recap lessons learned in 2020 and analyze the future outlook for the year ahead. We will start off by hearing from Palladium's Suzanne Wong about diversity initiatives being rolled out across her organization. We'll then move into a fireside chat with Professor Josh Lerner, who will discuss his landmark research on the AUM and the performance of Asian American Pacific Islander investment managers. Following Professor Lerner's insights, our panel of LPs and allocators will react to the landmark study and discuss how our industry can create broader access points for OPI managers. And finally, we'll conclude the session by hearing from a panel of industry experts as they discuss what we can expect for in the new year and the continued impact on the pandemic across our industry. For each session, we'll dedicate a few minutes for audience Q&A towards the end of the session. In order to participate, we encourage all of you to participate by submitting your questions to either the email address virtual@aim.org or via Twitter via the hashtag AIM. To kick off our session, I'd like to introduce all of you to Suzanne Wong. Suzanne is a partner at Palladium Equity Partners and is also its CFO, as well as a member of its management company. Leveraging her tax background, Suzanne is heavily involved with structuring all investments for Palladium, which is a middle market PE firm with approximately $3 billion under management today. Suzanne also happens to sit on Palladium's Strategic Investment Committee, which is working on initiatives to scale the firm in the years ahead. She is helping to lead Palladium's promotion of diversity and inclusion, which is a very important topic today, and includes a multi-pronged and focused effort by which they are focused not only on Palladium the firm, its portfolio companies, but also the industry at large. Prior to joining Palladium, Suzanne worked at Apollo Global Management, where she was the head of its tax finance group. Please join me in welcoming Suzanne to our discussion. Hi, Suzanne. How are you?
Good. How are you? Thank you.
I'm doing well. Thanks. Thanks for taking a few minutes out of your afternoon to spend with the AIM community. We really do appreciate it. Palladium has a really interesting history in terms of how it was founded, nearly 2 decades ago now. I think it'd be interesting if you could share with us a little bit more about the firm's history and really kind of its ambitions to kind of grow and transform the private equity industry in the years ahead.
Yeah, sure. I mean, as you know, there's been a negative halo over the private equity industry for some time now. And we want people to know that private equity can be a force for good. So, our history, Palladium was founded by Marcos Rodriguez in 1997. Marcos and his family fled Cuba during the revolution. His father was a waiter at the Plaza Hotel, and his mother was a pharmacist at Columbia Presbyterian. It's like millions of immigrant families across the country. They worked hard to ensure that their children and grandchildren had access to higher education and other transformative opportunities. And we at Palladium, we all come from diverse backgrounds and disciplines, and the firm has been a minority owned and led since its founding. We have built a firm that reflects the diversity of the 3 million beneficiaries whom we serve. And many of our family members are firefighters, police, teachers. So to us, our LPs and investors are not monolithic institutions to us. They represent our parents and our grandparents who worked their entire lives to provide for their families and save for their retirement. They have entrusted us with their savings, and we see that as a sacred trust. We have a commitment to diversity and inclusion, and this has been a hallmark of Palladium values in our 24 years of generating outstanding returns to our investors. When you look at the firm, currently, the makeup of our firm, Palladium's employees, around 73% of employees are female or minority. And when you look at the management of the firm, our partners, 64% of our partners are female or diverse. So we always go to seek to provide opportunity to help those that historically have been underrepresented professionals gain industry experience through our junior professional and intern recruiting process. We maintain long-standing relationships with many organizations that promote diversity, including Twigo, SEO, the NAIC, WAVE, I Have a Dream Foundation, 30% Coalition, NAA, and of course, AIM. And we feel like we've made a tremendous progress communicating our values, not just at the firm level, but also at our portfolio companies. We believe that our portfolio company boards are among the most diverse for businesses of any size. Our goal is a pretty big goal, but we would like to have 2 females and 2 minority board members on every board by the end of Q1 2021, which is coming up soon. And we're very close, actually. Right now, we're close to 90% at Fund 4 and 80% at Fund 5. So we're very proud of that. And the number of portfolio companies with female and minority C-suite representation within Fund 4 and 5 have increased. 50%. They were at 50% when we bought them, and now we're close to 90%. And we are starting at the board level because we truly believe that change starts from the top. In our view, the financial industry leaders really have an opportunity right now to catalyze real change in the industry.
That's great, Suzanne. It's impressive what your firm has been able to accomplish in really short amount of time relative to the industry at large. But if you reflect back and sort of where we may have been in the late 90s and 97 when your firm was founded, and fast forward to today, like how far do you think the industry at large has come, and what do you think are kind of specific tangible things that can be done either at the industry level or more specifically kind of what your firm is focusing on in over the next 10, 15, 20 years?
Sure. So around the time of our founding in 97, there were very few minority-owned funds that had broad recognition in the industry. And as a firm, we are proud to have witnessed and participated in the changing demographics of the private equity industry. But we feel like we haven't done enough. Right now, less than 5% of the private equity industry is owned or managed by women and people of color. From a broader industry perspective, we want to see scores of large minority and women-owned asset managers. Over the next 10 years, we want to see 30 to 50% of private equity industry owned or managed by women or people of color, because this represents the demographics of society, and we want to help lead that way. With regards to Palladium's own goals, our ambition is to be one of the best performing and largest PE firms in the industry, in the country, generating outstanding returns for our investors, employees, and communities, and helping to transform the asset management industry the Palladium way. To give you some background, we started with $1.5 million in 97. Today, we manage nearly $3 billion of assets. Over the last 20 years, we grew AUM by 30x from 100 million to 3 billion. If we kept with the market, which right now the private equity industries is expected to grow by 10x in 10 years, that would make us 30 billion. But we are actually aiming much higher than that. We're aiming to be 100 billion or 30x by 2030. And we will also work to grow the market faster as well. And we want to have 100 partners by then. That's a very different model than most private equity firms that you've seen. And we're looking to keep with our diverse culture. We have a fundamental belief at our firm that diversity and inclusion generates alpha and drives outsized returns. And right now we have a deep team of 51 professionals today who are eager to support and drive the firm's growth and manage more capital. As a team, we have learned a great deal over the last 2 decades. The 11 partners at Palladium have worked together for nearly 15 years on average. In fact, I'm probably one of the more, not younger in age, but less tenured partners at Palladium. I mean, that was one of the things that really impressed me when I joined the team. It's a very, close-knit team. And the level of trust and loyalty that exists between the team is very strong. Our culture is our strongest asset. And we have the luxury of attracting very strong talent. I'm confident that we'll be able to bring folks that share our values and help us grow. Our processes are well tested, repeatable, and transferable. Before you heard me say the Palladium way, so you're probably wondering what that means. To us, the Palladium way is performance, diversity, and giving back. So that's what we mean when we say the Palladium way. And we want to help the asset management business grow the Palladium way.
I love it. I really like kind of the approach. And I think when you look at the industry and some of the challenges that we collectively have to overcome, traditional thinking isn't going to really cut it anymore. Like, we have to think outside of the box. We have to set ambitious goals. We have to kind of push both based on merit, but also creating opportunity for those that have not yet had the opportunity to basically do what we get to do every day in our day jobs. So I really do appreciate that. Palladium as a firm has made it a point, I think, to be pretty visible with trade associations like AIM. And so I wanted to close with just having you share with our audience a little bit more about, how can AIM and our network and members collaborate with Palladium as you look to kind of grow the firm as you've outlined?
Sure. Well, as you know, Palladium and AIM have had a long-standing relationship and friendship that goes all the way back from the beginning when AIM was first founded in 2006. Marcos basically knows everybody at AIM, so there's a very long relationship there. And we're very much aligned with AIM in our views. We believe that today, financial industry leaders have an opportunity to really catalyze change. And driving change will require participation from and collaboration among all stakeholders in our industry. So at Palladium, we are always looking for new and innovative ways to further transform our industry, and would welcome the opportunity to discuss other ideas, approaches, and potential partnerships with, the network at AIM, everybody that is involved. I guess as we were thinking about our growth plan, and given our history with AIM, it was natural for us to discuss our plans with AIM and discuss how we can partner with AIM. Marcos and I have been having multiple discussions with AIM, and we plan on participating on all aspects of AIM, including the Emerging Leaders Initiative that you guys have. We plan on being involved with the 2021 National Conference and other conferences going forward. We plan on hiring from AIM's network and also finding co-investment partners in some investments that we're looking into. We believe that really working together with AIM and other industry leaders is how we're going to be able to make a difference in this industry.
That's wonderful. I really do appreciate the insight, Suzanne. Thank you so much for your support, as well as Palladium's support of the organization. And we wish you and Marcos and the team all the best, and hopefully we'll be able to connect in person in the new year when the environment improves for all of us in our industry. With that, it's my pleasure to welcome my fellow co-board chair of AIM, Brenda Chia. Brenda has been working on a really groundbreaking study that AIM is about to release, which Professor Josh Lerner from the Harvard Business School helped author and research on our behalf. And so I'm going to turn the discussion over to Brenda and Professor Lerner, where they can discuss the findings of our AIM Bella research study.
Hey, Josh.
Hi
Good
there.
to see you.
Great to see
How are you?
Very good.
Listen, you probably do not need to be introduced to our audience today, but is it okay if I say a few nice things about you to get us started?
Right.
Will that be all right? So you are the Jacob H. Schiff Professor at Harvard Business School. Most of us know you as the person who introduced one of the most popular MBA courses, Venture Capital and Private Equity. When I was in school, it was almost impossible to get into that class, and I assume that it's only gotten more so over time. You also establish and teach doctoral courses on entrepreneurship. You teach in the Owners, Presidents, Managers program, one of which you finished just last week, and you lead courses, executive courses on private equity. Not surprisingly, your research focuses on VC and PE firms and the impact of policies on innovation. In addition to all that, you serve as editor and lead a number of research organizations. So a very warm welcome to you at your first AIM event. You know that I've been looking forward to this because in a role reversal, I get to ask the questions today.
Great.
So earlier this year, AIM got together with you and Bella Research Group to work on a study. What we did was we developed a baseline understanding of Asian American Pacific Islander or AAPI owned funds. Mm-hmm. The study primarily focused on AUM and performance, and this is the first ever study on AAPI funds. Over the past 2 years, AIM has been asked by various regulators for statistics on AAPI owned funds. These include members of the House Financial Services Committee, and now we can actually have the data to share with them. We're hoping to make this a longitudinal study so that we can track performance and AUM over time. This first landmark study is supported by SID Investment Advisors and Sycamore Tree Partners. SID Investments is one of the largest Asian-owned managers of domestic and international growth equities and taxable and municipal fixed income assets. Roger Sid actually attended HBS before me, and he will be speaking on the second panel today. Sycamore Tree is a new fund that AIM would like to track. We have known two of the founders, Mark Okada and Jack Yang, for several years now. It is a value-oriented, durable alpha firm specializing in alternative credit. So why don't we jump right in? Josh, can you help us understand the parameters of the AIM-Bella study?
Great. I'd be delighted to, and thanks for the chance to talk about some of this work, which I'm very excited about today. So the idea was to take as broad a look across asset classes as we could, and we focused on private equity, which included the venture piece, hedge funds, public equities, and finally real estate. So, certainly a number of very big verticals, with a lot of capital in them. We focused on the period of, for instance, for the stuff that had, which was, multiple vintage years, like private equity and real estate. We went back to 2008 to 2020 on the grounds that would give, the funds which were likely still in the game and still active. For the hedge funds and the public equity funds, where it isn't that kind of vintage year structure, we just simply looked at the active funds. And in particular, what we were interested in was looking at ownership. And this was an important distinction, right? Which is to say that there are a lot of, mainstream groups which may have, a partner or multiple partners who are API, but that's not what we're looking at here. What we're really looking at is ownership. And I think we can talk, if you want, a little bit about why it's so important. Ownership is such an important thing to look at. We in particular looked at a 50% threshold to say, was it above this cutoff in terms of the ownership of the firm? We just did this U.S. based, and again, when you're thinking about why we did that, a lot of our focus was on saying we want to really look at this population here. It's not that there aren't interesting things to see around the world. That was our focus. Our focus here. And essentially to try to, we took a broad look in terms of geography. So we included Far East, Southeast Asia, Indian subcontinent. We didn't break it out from there. And, just to sort of calibrate, some of the numbers we'll see, if we look at population in the US, that would be around, 6% or so as the sort of the hurdle that was there, though on many other metrics, we would see, perhaps even higher measures, such as the Harvard undergraduate class or something. Yeah.
Yeah, perfect. So there's one more point I would like to make, which is the time frame of this study. It's really important for our audience to know the time frame was 2008 to 2020 in terms of vintages. And this is a different time frame from past studies, in particular the Knight Foundation study, and therefore the two studies are not directly comparable.
Right.
So I just want to make that point. And we will talk about the importance of ownership and wealth creation, I think, in the context of AUM. So why don't we go into the AUM discussion? And the benchmark here is AAPI-owned funds at 50% or more versus the entire universe of U.S. funds in the industry. So what we're seeing is that AAPI firms are underrepresented in the aggregate. But what can you tell us about the detailed numbers around AUM?
Yeah, so if we can go to the first slide, it gives a pretty nice depiction of what's going on. So what we do here is essentially look at the four buckets that I mentioned, the PE, the real estate, hedge funds, and public equities, as well as an aggregate, which is essentially a weighted average of those numbers, and essentially look at three compilations here. First, we do the share of firms, then we do the share of funds, because of course, many of these organizations will have multiple funds. And finally, we do the number that's probably closest to a bottom line number, which is essentially assets under management. And I think we see a couple of interesting things here, but certainly one of them is if we look at the right-hand column, which is the assets under management. And for instance, keep in mind that 6% number, which was the share of the population. We're essentially seeing much smaller numbers here in terms of the shares of assets under management. And in fact, when you sort of go to the bottom right-hand corner and try to say, what is essentially the weighted average across all the asset classes, we're only sitting at 0.7% of the assets under management. So that gives a bit of a sense of what our bottom line number is in terms of the assets being controlled.
So what's interesting about this chart, and I look at it when I move from the left column to the right column, the numbers are shrinking, right? So percent of firms, great, 3.5%, not great, but maybe decent. And then when it comes to the AUM, it's minuscule.
Right.
And this comes to the issue of scale and also wealth creation. The funds here are subscale at best. And we know that this is an industry of scale because of the cost of startup, operational compliance, all of that. So what is your take on scale as well as wealth creation through ownership?
Right. Well, I think one thing that we know about asset management, and I think this is as true for public equities as private ones, is that it's hard to create wealth from a small fund, right? That the fixed costs of, both doing transactions, whether it's doing due diligence on a private equity deal, or it's essentially, buying a block, researching and then buying a block of shares, are substantial. And that almost in every case, if you're going to be running a firm, you're going to need to do some substantial investments in things like marketing and compliance and so forth. So if you end up in a situation where you're running a $20 or $50 million of assets under management, it's just going to be tough. It's probably going to be tough for your investors, but certainly it's going to be tough for the fund managers, because simply the costs of doing business are just simply so large that it's going to eat away at whatever kind of rents would be associated with it.
Yeah.
And
Sorry, go ahead.
No, I was just going to say.
AIM's own research showed that for the smaller funds, the startup funds, about 70% of fees in the early years could go towards, back office staff, compliance, business essentials, and then as funds grow larger, that percentage falls to below 40%. So it really is, about growing the capital base, because without that, the AAPI owned funds will continue to be marginalized.
Absolutely, and you can see this, many examples of this, of organizations that may have, a really interesting founder with, a set of creative ideas, but unless they can sort of break through and reach that higher level of size, it's unlikely that either the organization's going to be terribly successful, but certainly that the founder is unlikely to get the kind of rewards for the knowledge and insights and entrepreneurial activity that we would anticipate that they would deserve for their skills.
Right. But I'm an optimist, so I see this as a lot of running room for AAPI owned funds. There's a lot of white space to grow the number of firms as well as the AUM. I think that's the positive way to look at it.
Absolutely.
Shall we now move on to performance? I think everyone who bought a ticket to this event really wants to hear about performance. That's what people really want to know. So let us bring up the chart on performance. And Josh, can you please just walk us through that?
Absolutely. And so, just by way of preface, right, in a way, when we sort of think about those low share of assets under management that we showed in the earlier chart, you can interpret that in different ways, but certainly one way is you might say, well, maybe the AAPI managers are not getting AUM because they just haven't done very well, right? And this analysis was essentially trying to tackle that more skeptical interpretation head on. So what we did here is essentially look at several classes of funds: the private equity, the hedge funds, and public equities. And you might say, why isn't real estate here? Well, that reflected the fact that we saw in the earlier chart that the AAPI share of the real estate was just tiny, so we didn't really have much of a sample to work with. We essentially looked at a variety of years, and clearly with the private equity, because we wanted to essentially have enough time for there to be meaningful performance, we limited the vintage years we looked at, right? As we know, the process of running a private equity investment is one where you raise the fund, you put the money out there. It takes a little while to find the opportunities, and then it takes a while to see how things are going. So we cut that off with the 17 vintage year. And we essentially did a variety of metrics trying to choose, what we might term as horses for courses, or essentially the right metric for the industry sector. And in particular, with private equity, we used TVPI, which is the notion of multiple of invested capital, as well as IRR. And then we essentially used, adjusted either annualized or monthly returns for the hedge funds and public equities. And then we essentially got a series of numbers, of return numbers, which are indicated in the fourth column, which are essentially either the increment to TVPI or IRR, or else essentially the adjusted or sort of market adjusted returns in risk adjusted returns for the hedge funds and public equity. And finally, we did a test to say, are these things significantly different from zero? So in other words, saying, in a way, what we would like to be able to say is both, is there differences? Almost invariably, it's not going to exactly match, but are those differences statistically significant? And as we see in 2 of the 4 cases, they indeed were.
So Josh, can you just explain to us the TVPI number of plus 0.25?
Right.
What does that really mean?
Right. So if you look at private equity funds over the last dozen years or so, they essentially have typically had multiples on the order of, particularly for the more mature funds, of around 1.5, 1.6. So what that's saying is that you invest $1, and after fees and so forth, you'll get $1.50, $1.60 back. And what this is saying is that when you look at the AAPI funds, they in general got a TVPI that was essentially 0.25 higher. So in other words, if the typical fund was returning a 1.5, the AAPI funds would be returning a 1.75. And as we see here, that's a difference that's not only meaningful in terms of the economics, but also statistically significant as well, saying this isn't just simply because of random noise.
Right, but that does not hold on the IRR side, right? It's not.
Well, I mean, I think one thing to note with the IRR is that it is in some sense a noisier measure, right? That when you look at the distribution of the TVPIs, you tend to get a nice tight bill shape. When you look at IRRs, it's a much more scattered kind of thing, that you're going to have some people with very large IRRs, some people with very small IRRs. And as a result, finding significant differences is often harder. One needs a larger sample to be able to do that, just simply because the noise that's there.
Right. And then when we come to hedge funds, the slight outperformance on AAPI owned funds, that's an annualized number. So that's really cumulative over time.
Right. So that's essentially saying that had you gone with the AAPI funds, you would have essentially done, on this, annualized adjusted basis, around 1.5% better per year than the peer group. So if the peer group was, let's say, returning, and obviously this varies from year to year with the market, but let's say the peer group was returning 10% per annum, essentially the AAPI funds would be returning around 11.5%.
Great. And this is a statistically significant number, right?
Exactly.
Okay.
So when we turn the cranks and do the usual tests, indeed, we're finding statistical significance.
Can you talk a little bit, without getting too wonky here, about how the analysis was done to account for different fund sizes and other factors? Right.
So, I mean, as you know, there's been a sort of whole business of performance measurement that's been pursued by both academics and practitioners. And the main notion is to in some sense control for the fact that investments have more or less risk, and in certain periods are going to do better or worse, right? So if you think about a really hot year, the guys who are investing in high risk tech stocks are almost invariably going to do better than the market as a whole, not necessarily because they're really that much better, but simply just they're investing in highly risky stocks where it mirrors the market in sort of exaggerated kind of format. And in a way, what we were trying to do is pull out those risk factors, such as the correlation with the market, things like, the value and growth orientation and so forth, and really try to say, what's the underlying performance, even after controlling for the mix of the investments that were being done by a given fund manager. it's in a way trying to really get at the essence of what the outperformance really is.
Terrific. Thank you so much. So, one of the conclusions we can draw from this is that there's really no downside, between this report and the Knight Foundation report, there's really no downside to investing with diverse managers. They do tend to be small, yes, so it's harder for LPs to gain scale. But in fact, by finding the right managers within a pool, say the AIM pool, the AAPI pool, that might actually be a small advantage to investing in these funds that are able to deliver, above average performance and to be able to, grow with the LPs. Personally, obviously, I would like to see an increase in the sample size of these AAPI-owned funds. And hopefully we will get there as we continue to do the longitudinal study. I did want to spend a little bit of time talking about the scale issue and the supply issue. So the way I think about the scale issue is that if we took a look at the universe of AAPI-owned funds and the LPs just grew those funds, right? Can we actually analyze the impact on AUM and performance over time?
Yeah, it is certainly an interesting question, is how you get growth. And I think that, almost invariably, and this is really true for diversely owned funds in general, is there's really got to be two levers, right? One of which is helping groups grow. And obviously, in a way, the idea is not to, dump a fire hose of money on a group, because we know that, hyper growth can often be associated with, just a lot of, growing pains, right? It just is hard to really morph from a 10 million to a $10 billion fund in a short period of time. And, certainly many of the groups that have tried to do that in general have, to a certain extent struggled and, lost their way. So certainly part of it is about growing in a prudent manner. But I think there's another side of a coin as well, which is increasing the pipeline. And in particular, we know that when we look across asset classes, whether private equity or hedge funds or real estate, where do new managers come from? Well, in a lot of cases, they come from people who were senior investment professionals at bulge bracket established, well-regarded groups who spin out and, on the basis of their track record and their success and their exposure to the way in which a well-run firm is managed, are able to go out and raise a fund themselves. And I think that we really should emphasize both sides of the coin, that certainly helping groups grow in a smart way, avoiding some of the pitfalls that some of their predecessors in their respective industries have run into as they've grown, is important. But also really building the pipeline there. That's obviously not as much of a quick fix that is an overnight thing, but it's also an important area to be undertaking investments in as well.
So one of the things that we did look at in this study is the pipeline, right? So Bella Research did find that AAPIs represent about 14% of students attending the top U.S. business schools, and about 16% of entry-level financial analysts into banks and investment houses. However, we're not seeing the blossoming of AAPI funds, except possibly only in venture. That's the only class where we're seeing, people come out and launch themselves. So I think this is something that AIM can really work on, and it's a personal passion of mine. And I think about it in a framework of three things, right? The first is the regulatory initiatives that we're taking on. The second is the structural initiative, and the third is the cultural/financial. So As you know, AIM is already working with the SEC and other regulators to establish a baseline and to be able to track progress of all diverse managers, not just AAPI managers, but we feed into the AAPI data. When we look at the structural initiative, what I mean by this is that we would like to see AAPI own funds to be included in diverse manager searches and programs. There are LPs and consultants who, through their own policy, exclude AAPI funds, and we are working to change their mind on that. Possibly the most interesting area to me is the cultural and the financial initiative. There is personal risk and potentially a very high cost involved in becoming a fund entrepreneur. So in both the issue of scale and I think pipeline, AIM can build the scaffolding for our constituents and to make sure that we have a very robust community. We're working on several things, but there's going to be a big announcement coming up next week about a new partnership between AIM and a money center bank. This may be discussed at the next two panels. I don't know if people are going to talk about that, but I'm looking forward to the announcement that's going to be on December 10th. So those are my thoughts on how AIM can work to improve participation and numbers. What are your thoughts and advice to up and coming managers who are listening to this and hoping to grow?
Yeah, well, I think that certainly those are all sound like great ideas. I think the more that can be, under that last basket of, culture and so forth, right? There's a lot of stuff, right? And certainly, I think there's a lot of opportunities for mentorship and encouragement as, young people climb the ladder at their respective organizations and hopefully, build the kind of track record that ultimately will allow them to go out and do their own thing. I mean, one thing that I might add to the list is, certainly engaging with the limited partner community as well. And you may be already doing that, but we there was a piece in the Journal a couple weeks back on the effort that David Swenson has done to reach out to his managers and underscore the importance of diversity on the part of their teams. And I think the one thing that we do know is that general partners tend to or fund managers tend to listen to the asset owners, right? When the asset owners express a strong opinion with conviction, it tends to get attention in a way that just outside chatter by academics and others saying that wouldn't it be nice if the world was like this, it gets their attention in a very different kind of way. So I think that thinking about engaging with might be a really interesting area as well. Yeah.
Yes, AIM was actually launched by CalPERS and CalSTRS, so those are our roots. And we've worked closely with many public pension funds. I'm actually speaking on the New York City Pensions CIO panel on Friday. So there was that, and we're trying to expand, the LP base. That's why the partnership with the bank is so exciting. We're helping them build their diverse manager pipeline. So expanding the LP base to benefit, our constituents would be terrific. So I think we're just about out of time. Thank you so much for your time today. It's been terrific. So nice to see you, and I hope to see you in person soon in the Boston area.
That sounds great.
Yeah, everyone, the AIM Bella report will be available on the website tonight, so go ahead and download it. So now I'm going to bring on Susan So and her panel of LPs and allocators to discuss the findings of the study. Susan is a longtime board member and Chief of Strategy and Capital Development at 2 Sigma. So Susan, it's all yours.
Great. Thank you so much, Brenda. And thank you, Josh. That was great. So excited to be here. And as Brenda has mentioned, I am a very proud member of AIM and having been a part of the board and the opportunity to work with folks and on the important initiatives is something that's very important to me personally. And so thank you. Before we get started, you can see a lot of faces here. I'm really excited to sort of introduce you to my fellow partners in crime today during our little panel here. But I want to just give a couple of introductory words. One of which is, while doing this, I also have a day job, just like everyone else has. So I'm going to make sure folks tell you what they do during the day, and we will have a little bit of fun with this panel as well. And most of you know from these, my day job, I lead strategy and capital development for the private investment markets over at Two Sigma, where we cover both venture, we have an impact-focused middle market buyout fund, as well as investments in financials and real assets. So that's relevant only because you'll see my perspective will kind of come through from that perspective. As we talk about today's topic, which is, a lead on to the study, whether there's an opportunity gap for Asian American and Pacific Islander managers, can the industry create broader access? We will also expand it further to focusing on diversity and inclusion, because at the end of the day, I think it's always important to step back a little bit. But most importantly, we have an amazing group. I'm joined by three folks here who I absolutely am so excited to be a part of today, who bring diversity of thought and unique perspectives. And so I'd like to introduce Suzanne Gilley, who is the Senior Investment Officer with Common Spirit Health, formerly known as Dignity Health. Now, what's particularly interesting about Suzanne, other than her love for boba, which we talked about, and you'll learn a little bit more from her. One of the reasons I particularly wanted Suzanne to join us, you'll see she won't hold back on anything, but more importantly, given the nonprofit health organization she works for, she has a really interesting perspective prior to in both public markets and hedge funds. And prior to that, she came from the public plan world, where she can also hopefully share some of her learnings from Texas Teachers. Brian O'Neill, who is Chief Investment Officer of Robert Wood Johnson Foundation, really needs no introduction. He has been a strong supporter of AIM, and we thank him so much for all his contributions. He brings to us his unique perspective from the endowment foundation space, being one of the top CIOs in that space, and therefore can give us sort of the broad asset allocation viewpoint, but also previously had spent much time in the insurance space with AXA Equitable. So I really look forward to his insights. And then last but not least, we have Heidi Poon, who is a fellow AIM board member, who we chat all the time, and is a managing director at Axia, which is the global alternatives consultant specializing both not only in private markets, whether it's private equity or private credit, but also in hedge funds. And Heidi brings to bear not only her expertise in the private markets, which particularly also includes venture and growth, she also brings to us her prior experience on the public plan side as an allocator with San Jose Retirement. So we've got a nice big mix here today. And since I've introduced folks already, I thought we could just turn it real quickly. If each of you could just describe at a high level your organization's investment program, because I think that would be relevant for folks. And then please don't forget, we have sort of a fun question as I get to know you. Name something that you have truly binged on this year. I will tell you and share with you that Netflix has been my one true binge this year. Many of you know I make a lot of cakes. I never eat them, so that's not a binge. But I have been able to catch up on all the trashy TV series that I never had time to watch. And I feel like I'm back in my early high school days where I was binging on Chinese soap operas or Korean soap operas. So that's been my one binge. So with that, I'd like to turn it to Suzanne, allow her to formally introduce herself and talk about her investment program. And don't forget the fun question.
Absolutely. Thank you, Susan. So I'm Suzanne Gilley at Common Spirit Health, and we are a $22 billion, $23 billion on great days in the markets healthcare organization, the largest not-for-profit hospital system in the United States. And we were founded by women over 150 years ago when nuns from Ireland came to the Bay Area to help those panning for gold and their opportunity for wealth, and to offer affordable quality healthcare. So that's the organization. So serving others and providing access to all is a part of our organization. Like many healthcare systems, we have multiple pools of capital, both corporate assets for our growth, CapEx and expansion, as well as an open DB plan and other foundation endowment assets and retirement insurance assets. Also on the retirement side, we have $13 billion defined contribution plan, which I can possibly bring up later, and how it's relevant to diversity and expansion and awareness of opportunities. Quickly to switch to my thing that I binged, I am a junkie for crime detective TV shows, and find myself often getting too busy to see things, and I don't have any of the cable shows. In fact, I don't own a television, but I watched absolutely every show of the Americans with more speed than I would like to admit, and just couldn't believe it when it came to an end, and I'm still chewing on how it ended. So that was my binge survival strategy over the summer.
I'm going to add that to my watch list.
Oh yeah.
Brian.
Okay, I'm detecting a common theme here in the answer to the question. I'm going to contribute to that. But first, in terms of my work, Chief Investment Officer at the Robert Wood Johnson Foundation, which is an $11.5 billion foundation that is focused on the healthcare system and health in general. So as you can imagine, this has been quite a year for us. We had the worst epidemic to hit this country in 100 years. And we've also had a lot of issues around disparities, racial and healthcare disparities, income disparities. And so it's been quite a busy year for us. And I have a 10-year-old still living with me, and our day is now structured, our evening after dinner every night is movie night. And we take turns watching a movie. So I have to say I've seen all the Avenger movies. And I've tried to be more diversified in what I do, but after 10 months, I'll tell you, I am really running out of ideas. So if anybody wants to send in some more ideas, I would really appreciate that.
Wait for Wonder Woman 1984. That's coming. I have 2 teen boys. As much as they hate female protagonists, they will watch that one because it's a Marvel movie.
Right.
Heidi, please.
Susan, you need to deprogram your sons.
I know.
From that bias. That's a to-do for you for the rest of the year.
That's my New Year's resolution.
So as Susan already introduced me, I am Heidi Poon. I'm Managing Director, Private Equity Research for Axia. Axia is a global advisory and portfolio research platform across all alternatives asset classes, hedge funds, private equity, real assets, real estate, and also private credit. We are very global. We're headquartered in New York, but have offices around the country and also in Asia, as well as London. We advise upon $160 billion in assets, but also manage over $10 billion in assets across all these asset classes. In terms of my binge, I have a show to contribute, but the name might not be pronounceable in public, but it's kind of Schitt's Creek.
Love it.
So really love it. I'm shocked at the speed to which, I'm actually watching that show. But, other than Netflix, unfortunately, I probably have consumed more carbs so far this year, maybe 3 times of what I've consumed the year before. So got to put a stop to
that. I love it. If you haven't seen it, Good Place. That's a nice one also. Write it down. So I forgot to mention to our audience out there, we would like this to be participant involvement as well. So if you do have also an answer to the fun question that we've asked our panelists, you can email us your answer at virtual@aim.org, or if you prefer Twitter, go to hashtag AAAIM, so hashtag AIM. Any of the interesting ones, I will actually be citing them out at the very end. Also, we do have the ability to ask questions, so we will be saving just a couple minutes towards the end. And so for folks who have questions, please also send them to either the chat at Twitter or the email that I just gave you. So with that, let's jump in though to the meat of the topic here. I appreciate the investment background, which is fantastic. It's good for us to see where each of you is coming from. Could you, if you wouldn't mind, sharing with us your organization's approach to diversity and inclusion? And if it's perhaps tied to a mission in particular, that would be great to know. So maybe we'll turn it the other way. Let's go with Brian, since I started with Suzanne earlier.
Yeah, well, thanks, Susan. And, I want to go back to 2012 because that was the 40th anniversary of the Robert Wood Johnson Foundation. And we had quite a bit of sort of a history of all the various programs that we'd done. And what came out over and over again was what we called our human capital programs. We'd given people scholarships for medical school, dental school, nursing school, research grants, and had created a huge alumni group of people who were really grateful to the foundation for having helped them at an important moment in their lives. And that was the aha moment for me. We could do that in investments. And so the first thing that we started was an emerging manager program. And that began, and it's now in its 8th year. On top of that, we've also added some non-emerging women and minority-owned managers. But the thing that I really enjoy the most is that we've come to see that, as it was discussed by Professor Lerner in the previous panel, the pipeline is so important. And we now work with 3 pipeline organizations, SEO, Girls Who Invest, and the Twigo Foundation. And the great thing about being a foundation is what we do is we give money away. So all 3 of those organizations are grantees of ours now. We support them as well as hiring their students and providing them with internships. And I really do think that that's one of the keys to having greater diversity in the investment business over time.
That's great. Suzanne, you nodded your head.
Brian, I have been an ambassador, which is what they call them, for Girls Who Invest since they started the program. And last year, I think just because of COVID and everything else that was crazy, it was virtual. I had 2, in part because I've been doing it for so long. And I have actually just connected with an Asian woman portfolio manager, and she is an alumnus from the same university as one of my scholars, GWI scholars, and I'm going to connect them. So there's an element of which the network of support and the engagement to support, to both build the pipeline, to be aware of it and create connections. And in some ways, it really just reminds me that you have to ask the question and bring it up. So thank you for supporting financially GWI. There's a lot of organizations that are so worthy for our time as well as our capital. And also this is Giving Tuesday, so another reminder for what we can accomplish. One of the things that really was inspiring for me when I was interviewing with Dignity Health and now Common Spirit Health was that diversity and inclusion is part of the fabric as well as specifically the history of the organization. So the social justice of providing healthcare to those who deserve it, which we think everyone does, is really intrinsic to who we are as an organization. When Dignity Health and CHI merged, we were blessed to have both organizations with CEOs who are African American, and they serve together for the complexity of this 21 state footprint, as well as all the regulatory requirements to knit a large organization together. And while one has retired and stepped down, the board, the C-suite, as well as the leadership of our investment team, and up and down across the organization is highly diverse. So it's the oxygen in the room at Common Spirit Health, and for that I am grateful to be able to participate, because it really to use that is an extra boost and oomph in the conversation for diversity. And in many ways, we will show up to manager meetings, and we will have all spectrums of diversity in the room on our side, and often be faced with managers who we seek to encourage them to expand diversity in their organizations, or meet organizations that are led by women, led by Asians, led by people of color. And it's important to us, and it's a part of what we do. We do not have a dedicated emerging manager program, although Texas Teachers does and actually hosts one of the largest conferences for emerging managers. But it was really great to be a part of an organization where we put our capital work and grow and serve the organization. And we believe in what I'll call double bottom line. And that is that there are great managers with great returns, as Professor Lerner just presented.
Yeah, that's great. Thank you, Suzanne. Heidi, do you, I'm not sure if Axia actually has a diversity or inclusion, but I'm sure you have lots of comments on this. So maybe you can add a few words as well.
Right. So as a global consulting firm, of course, we have worked with a lot of clients on their emerging manager programs or, broader, diversity goals for their overall programs. But internally, actually, we have been very active, in terms of creating and promoting a diverse and inclusive environment. In 2019, Axia actually launched a diversity working group, which spans the global offices. And the goal, as I said, is to, promote the very diverse and inclusive environment through more retention and also recruiting efforts, but also provide education and anti-bias training to our workforce. So we have partnered, for instance, with an organization called Modern Guild in order to maybe target more underrepresented groups in our recruiting processes, as opposed to limiting our recruiting in certain universities, which is very common in our industry. We're also launching an adopt a school program in London and our US offices so that we can further broaden our recruiting efforts. There's also more initiatives about providing anti-bias training, especially for interviewers. We were so used to a certain mode or certain types of people when we interview through our careers. So I think this would be a very important initiative for our organization.
That's great. And we'll talk more about that because actually those are really some really interesting things that I want us to get to. I am curious because clearly diversity and inclusion is a focus for all of you. Do your organizations actually track it though? Or is it just more, part of the nice objective to have? And if you do track it, is it done by levels? So you could see, how people graduate over time and, to the extent you're comfortable, are Asians actually included in that diversity measure? Anyone want to handle that one?
We actually have.
Well, go ahead, Heidi. Yes, because you would have so much data. That's one of the things I'm saying is that you just said the thing that I'm looking for is where is great data?
So it's funny because, as a consulting firm, we participate in so many RFPs. We probably have answered that question hundreds of times, if not thousands of times. I think there's also the element that, when you're in a global offices, each jurisdiction has very different privacy laws. So, this year we did launch, a first firm-wide sort of self-identification type questionnaire to get better data. This would also help us, of course, in our recruiting efforts, really target areas where we're more deficient in terms of representation. So, I think data, it's definitely something that we're very focused on at Axia.
Heidi, can I ask, so how do you get data on the managers, and how are you, just like you said, there are regulations, and I agree, we should be so engaged that self-declaration could be part of the solution. But when your clients are saying, how do I run a search? How do I find out if not only the owners of the organization are diverse, but maybe the analysts or maybe the middle tier up and comers? The data is so hard to get at.
Yeah, so I think self-identification is a really big element of that. But definitely, we have been making an effort to collect that information on a firm basis. So we have sent out questionnaires to managers of all our asset classes. Of course, it started with hedge funds at Axia, and ever since the acquisition of Torico, we've also started that process with private equity and real assets managers. So definitely, it depends on whether the firms are responsive and whether they're very transparent. But with each due diligence, for instance, in our private equity due diligence, we also ask for this information should the manager agree to provide it. This would help us, of course, bolster our database in terms of, minority women-owned firms, but also we have started asking whether, more senior representatives or senior partners are, women and minorities. So some clients in particular, especially those with emerging manager programs, actually require that, their managers that are trying to get into the program fill out some data. So I think, as the comment earlier says, it's really ultimately the capital owners who can drive a lot of these changes, and that includes data collection.
Heidi, have you noticed, and maybe for both Suzanne and Brian as well, I mean, one of the things we had heard, particularly with public plan clients, but as you mentioned earlier, Heidi, with RFPs, that's become an increasingly important question that people need to answer. And that also becomes a burden for some of the smaller managers who don't track that. But have you found in this environment, particularly this year of 2020, that that's become increasingly important and that you're actually getting responses?
I think smaller and newer organizations actually are very eager to fill those out if they think that that could help them in the fundraise. Where we encounter, pushback on responding sometimes is really more, larger, more established organizations. So I think, especially when you have a team of 6, it's very easy to fill out a questionnaire like that. And really, you only have to do it once and, update regularly after that. So we haven't really found a lot of pushback from small organizations.
Okay, great, thanks.
We're tracking it internally for our publics, but we're embarking in sort of coming year on getting that information for our private equity managers. In part, so many managers, so many line items, and that data is going to require some combing through. But it's definitely hard to get at.
Do you think you would go as far as David Swenson has in your programs, or maybe, and this is for all of you, but I'm curious for Suzanne and Brian, in your direct allocation seat, where you would not give a mandate because they, either don't qualify or they're not reporting?
Well, let me answer I'll give you a question.
You guys in the hot seat today.
Yeah, that question. That, I talked before about emerging managers and women minority-owned firms. That leaves sort of the big clump of all the others. And yet it's a much more complicated process, because if every LP investor like us had our own questionnaire and sent them out to all of our managers, they'd spend their entire day filling out questionnaires. So what I see happening, and we are participating in at least one and probably 2 this year, is a few organizations setting themselves up to send questionnaires to many, many organizations and have the benefit of then limiting the burden on the GPs, but also giving them the ability to take all this information back and do some analysis and some massaging of it before they give it to us. And I think that's where we're going to end up, with a fairly small number of organizations that will do that work. And then we'll be able to look not just at this manager or that manager, but look much more broadly. And what will we do with it? I think it's going to be first level setting and then looking for progress. And different size organizations also should be expected to progress at different rates, I would say.
Sure.
Yeah, I think, to me, the angle is, yes, we want to see diverse firms, that are launching or have small assets and are growing, grow. But I also want to see the majority firms, the mega asset firms, expand their diversity. And in some senses, because of their assets, because of their employee turnover, they're a throughput path that could be quite compelling if they put their mind to it. And so in some ways, it's really about raising the question and bringing into a conversation in a gentle, loving, winsome way, if you will, and continuing to bring it to the conversation so that they understand that it's relevant and meaningful.
Thank you, Suzanne. That's a perfect segue to another question or topic we talked about behind the scenes, which I'd love us to talk about, which is all of this at the end of the day, increasing awareness, also links quite closely to what we were just talking about in the prior panel discussion, which is increasing the number, right? How do we encourage more diversity, and how do we ultimately get either the pie larger? Maybe it's not doesn't have to be zero-sum game, but Brian and Heidi both had another perspective, which I'd like us to talk about is, rather than just increasing the number of Asian American managed funds, which is what our research study talks about, but also to your point, just increasing the number, what do we think, if at all, is there a better path? Asian American owned funds being more in number, or is it better to have more Asian Americans working for larger firms, but where not just the pipeline or the funnel, but that they're in more leadership positions as a portfolio manager or at some other C-suite level? We certainly have had some success stories. You see that with very large, unnamed private equity firms. We have two very strong leaders there who are Asian American, but those are few and far between, although I do think we're on a path. I'd love you guys, if you're comfortable talking about, do you think one path is better than the other, or can they both be equally impactful?
I'd say they're both equally. I'll go first because, I think they're some people want to start their own firm and some people want to run the firm that they went to work for. And that's almost a question of personality and also, how you feel about being the boss versus, being part of a bigger team. And so I do think that for us, it is on the one hand to be looking for and hiring emerging managers, but also to do this demographic work. And it's going to take some time, but to sort of say to the larger firms, we want to see you recruiting, promoting, and putting in responsibility a more diverse workforce than you have right now. And, I think that they're making the efforts today. You can see that. It's going to be up to us a bit to hold their feet to the fire and say, let's see the results.
And frankly, I think that's part of the tumbleweed effect, if you will. And that is when the large bank asset management firm divisions are hiring more diversity, those are the people who learn what it is like to sit in front of an institutional investor, understand institutional infrastructure, the way things are organized and done. And if they get to the place where they're like, I don't want to be a part of this, $200 billion organization anymore, then they can put up their shingle, and they got the pedigree, they got the network, they got the experience, they got the relationships to make it happen. And so I think in some ways the pie grows faster if the diversity happens in the larger organizations. But I don't want to take away from someone who's already put themselves out on a plank and basically said, I'm here, I'm good, this is what I'm about. My angle on that is, in some senses, the foundation endowments might have a history of, and maybe it's because of incentives or other things, of being circumspect about the managers they're hiring, the managers they're investing in. And what I would say is that's fine, but let's agree that being transparent with each other for diverse managers so that we can actually bring awareness to where we're putting our capital, the people that we've spent time working, spent time with, and understand their philosophy and process, and be engaged and transparent with each other. I think that's the step that the allocators need to take.
That's great. Heidi, did you want to add something? I know you had some earlier.
I agree with Brian's point that really it's the more the merrier. It's driven by personalities. But I do think that, if we're a little bit cynical about it, if I look at how a lot of emerging manager programs, how the criteria has been written, it's really driven by ownership rather than senior ranks representation. So from that perspective, I do think that is really important to have more minority-owned firms, Asian-owned firms. And by that, I mean majority-owned, because that's usually how the standards are written as well.
Okay, great. Thank you. So let's move back to sort of emerging managers then. We have seen through the Bella and AIM research study shows that, despite underrepresentation, if you actually look at the AUM relative, we have a high number of small subscale funds, which, as we all know, that makes it harder to grow. You guys have all said that as well. Maybe there's a benefit to staying internally. But to the extent that you want to be more entrepreneurial and have your name or be able to build very early on, we also know that you're going to struggle a bit because you're much smaller. Are there other suggestions that you guys could suggest to help a newer fund? It doesn't have to be necessarily Asian American, but here we are for AIM. And one alternative, as you guys have discussed, has in fact been an emerging manager program. Do we actually think that's the better path? Or are there other recommendations that you might give to some of our managers out there who are listening? Who would like to take the first crack at that?
Brian, can I ask you, how have you leveraged your emerging manager program, either with other CIOs that you know, or graduating, if that's some of the words that you or others use? It's one of the things that can end up happening is a little bit of the kids table environment. So the question then is where's the proof in the pudding and the graduation, or are there other ways that you get at it?
Your question is easier than Susan, so I think I'll answer that one.
Good, you can answer mine.
Totally. Answer either one. Just want to get your views.
When we started the Emerging Manager Program, we had 3 goals. We wanted good investment returns, we wanted to identify some outstanding managers, and we wanted to have graduates into our mainstream program. And I'll say all 3 of those take time. The third one was the toughest. And I think we have like 3/4 of one at this point. Because I think making that transition is very difficult. But then to go to Susan's, you don't choose to be an emerging manager, you are one, meaning you don't have enough assets.
That's a good point.
Yeah, you need to raise more assets. And so if you're looking for emerging managers, you're finding people who have gotten started and they didn't have a $2 billion launch. They had a $20 million launch. And so, you're combing through that pool of people and looking for the people who you think will do the best job. And, the benefit of being an emerging manager hirer is that you have an incredible impact on them. You help take them up the curve from not having enough assets to pay for the organization they want to have to getting there and to getting beyond there. And so I think that's a great thing to do. But it is really tough to go from whatever the lower level of, sort of break even to having, what's for you, the target level of assets. That's very tough because you have to have years-long track record and you can't afford a lot of blemishes on it when you're in that asset raising. So that is, I think, the hardest part of this.
And that might not even necessarily be if you're in an actually emerging manager program, right? The reality is there are certainly some public plans where Asians do not qualify for an emerging manager mandate. But I do think in this environment, and I hope you guys would agree that that's changed. Right now, it's more focused on diversity. I know in the past with other funds that I've worked with in prior lives, some women-owned and managed funds have said specifically, I am not applying for an emerging manager or minority or women-owned mandate because I actually think that's a knock. I'm just as good, so I'm not going to go for it. But that being said, I agree with you that to the extent you can qualify, why not get the help? But you are pointing out one of the more difficult hurdles when you are at that stage. Heidi, you mentioned something you had heard, which I thought was interesting, which were some suggestions or recommendations that people could be doing in the industry to help that. Maybe you could talk about that. And maybe, sure. Suzanne, you're nodding your head too. Sounds like you have some suggestions as well.
Yes, I think it was a couple of years ago when I was at another diverse-focused conference that, I was speaking with one of the investment officers from a large public pension, and he also mentioned the challenge that Brian pointed out, which is that by Fund 3, that's really a very critical point of the life cycle of a newer manager, because that's a sort of make or break point. You either graduate into the main program and, and you're successful in accumulating more assets, or you kind of fade away and you're kind of orphaned from there. So I think the investment officer was suggesting that for there to be sort of like a bridge program to basically extend the runway for these managers, perhaps into the third and even a little bit of a fourth program. I think it really depends on the strategy. Sometimes earlier strategies just need more of a runway, and thereby sort of extending that period of observation and easing that potential path into the main program, or just giving them more of a chance of having a little bit more time to build out the track record to prove that you can realize investments and therefore achieve more success in fundraising. So that's one way of thinking about it. But of course, a lot of people would argue that by the time you hit third and fourth fund, why do you still need help? But I think if you do look at the empirical data, at least the experience that we have, just kind of going through the life cycles of these funds, especially nowadays, people are, because of the realities of the industry, you're really returning to market quite quickly. So by the time you are raising your third fund, a lot of times your fund one probably should have some markups, but really no realized track record either. So I think that becomes a more challenging conversation, for you to argue your case to be in the main program. So some sort of interim program is something that I think the industry or really allocators could consider. But I think that's a controversial topic, and I think people have very different opinions on that.
Agreed. Suzanne, do you have any words? Otherwise, we actually need to go to the Q&A session, but I didn't want to take it away from you if you had some other thoughts.
I think I'm happy to jump to the Q&A session, and I can weave in some thoughts as we move along.
Okay, so tied to this, actually, in fact, one of the audience questions was, so who can make the greatest difference here? Not necessarily emerging managers, but promoting talent cultivation, capital access, or fund launches when you are at the stage that you are at here that we're talking about. Now, my thought is, maybe it's everyone. It's not just government and public policy. Some of the work that Brenda's been doing with the SEC, I think, is really critical. Maybe the call to action for AIM. This is something else we can continue to be pushing for. Public pensions with your RFPs, or also all of us from the community. But curious if each of you has any other view as to other things that you really feel could make a difference here.
One of the things I just want to throw out, and maybe I'm throwing it out because I haven't heard anyone speak of this, and that is, family offices, and maybe from the perspective of Silicon Valley and all the ethnic diversity and gigantic amount of wealth that is distributed there, and I believe in allyship. I believe in the importance of allyship, and so if family offices actually thought about their role, just as they enjoy being seed or early stage investors in VC, that the opportunity for diversity, giving back to a community, giving back to a state, a location, some other organization or ethnic orientation that they believe in, would help. Because in some ways, I'm imagining that Brian and I have, and maybe Heidi, lots of her clients have the situation, which is, if someone shows up with $5 million in assets, or God forbid they've grown to $20 million, it's really hard for someone of our size to actually do something with that. Even 100 million is pretty tough, and there is an element of what I'll call virtuous circles, not cycles, of family offices that it would be interesting to see in this post George Floyd, Chris Cooper awakening, that can actually see people use their capital for opportunities. I'll just pause there and let others jump in.
Well, I might actually add something. I think that's a great idea. Brian, I'm curious your view too. But we see that generally with ESG now, right? And sort of the push for that, which obviously diversity initiative falls within there as well. But a lot of the family offices, the next generation is the millennial generation, and they care much more about that. And so that is actually a great piece of advice for our audience is, and maybe that's going to be another topic that we could be doing for another AIM event, is talking to family offices. They can be earlier, they can be more impactful in many ways for newer firms that are starting up. So I think that's a great suggestion, Suzanne. But Brian, you were going to say something as well.
Yeah, but she's really right, because a lot of those families are values driven in different ways, and this is one way that they can put that into practice. I was going to say, Brenda has told me that AIM is going to start, for lack of a better word, coaching people who want to start their own firms, and I think that's a great idea. I think not just AIM, but NASP and others, because you have to take on a lot of new challenges when you start an organization. And if you can learn from others so that you don't have to live through every step of the learning curve on your own, that's a huge time saver, and it's going to raise the success rate. And I really do think that that will be a great initiative if AIM does that. How do you find a back office? How do you find a good lawyer? How do you talk to people when you're raising your first $50 million? And I think that that's a time when coaching will have a big, big payoff.
Agreed, absolutely. Actually, the audience question that came in as a result to your comment is, what are the mentorship or coaching resources that currently exist? I think that's a longer conversation, but definitely something that will be an important part for AIM and some of these other organizations. I don't know, Suzanne, if you or Heidi or Brian have any thoughts of other ones, but they do exist. We've seen them. We, as a firm, not necessarily for starting a fund, but we certainly hire a lot of coaches to help train our portfolio managers to speak. And it's really helpful. If you are on the hedge fund side and you are fortunate enough to work with a capital introduction group, they often help you very closely on your launching and your pitch deck. Those are resources that you should certainly be seeking. And there are definitely a lot of independent firms I've seen that have now come to market over the last few years. People who are at large firms as marketers now serving as consultants to help you launch your firm. And some private placement firms will also do that as well. But I don't know if you guys have encountered that.
I think the real issue is the scale, the cost. Like, there are people that are very expensive and are very good, and so the real question is how do you help? And frankly, I like the idea that AIM is possibly going, even could make their network available. In other words, so and so enjoys this asset class, so and so enjoys working on presentations or public speaking or other kinds of things, and some of it is about paying it forward, right? If you were a firm that someone did well by you and you did well by your LPs, to pay it forward and give back in that dimension.
No, that's great. And I will also, I would be remiss if I didn't say, we mentioned this earlier, but one of the things that we also do at AIM is our Emerging Leaders Initiative. That's not necessarily focused on helping to launch a fund, but certainly is there to help our next generation members to take it to the next level. And so we'll be sure to sort of include that as well. We have just a few more minutes left, but I think we may be done with we won't have enough time to get to our last question, so I apologize. And we want to finish sort of on the fun note again, which is how we started. So some additional feedback we got from the audience, some other show suggestions for people are Queen's Gambit and Peaky Blinders. Actually, I haven't seen either one of those, so I'll add those. Personally, I've started on all my Christmas shows now, so those are terrible. The sort of binge-worthy, quite a number of folks said the Lush face masks, especially the coffee mask. Maybe that's a great holiday gift for folks to think about. Go online, cyber shopping. And then, of course, Theo chocolates is the other. So my closing question for each of you, though, now, we did not once talk about we actually not once really talked about COVID, but certainly there is the promise of a vaccine, a promise for 2021 to be better, and a promise that travel plans which have been on hold may actually happen. So I'd like to ask each of you, what is the one place that you plan to vacation on once we get back to more normalcy? So who would like to take that first?
Can we only say one?
No, you can do a round the world tour if you'd like. So allows us all to dream. So Brian, what's your answer then?
Well, Thailand has to be on there. There's a family connection there, but I also want to go back to Tuscany.
Very nice. Very nice. Heidi, what about you?
I would like to do a safari of some sort. I definitely miss that experience, and it's very exotic, for me. Although I've been going to the San Diego Zoo and Safari Park just to get a taste of that in the interim.
That's fantastic. And Suzanne?
I had COVID disrupted 2 trips this summer, so I want to get back to them. Mexico City and
Nice.
Singapore.
Nice. Well, see, around the world. I will add 2 more around the world. I want to enjoy the sun and the time on the beautiful beaches of Maldives before the atolls disappear in the water. And I'd love to see the Taj Mahal in India. And then the one travel I truly, truly hope I can do is I hope that I will be able to see all of you in person at next year's AIMS National Conference. So with that, I want to thank you all for joining me on this panel. It's been my pleasure. I hope this was great for you guys and for the audience. I'd like to now turn this over to my fellow board member and co-chair of AIM, Sanjeev Shah. He will be joined by this great panel. Our panel is fantastic. Let's see what he can do next as they talk about the outlook for 2021. Thanks again, everyone.
Thank you.
It's time for our final panel of the day, where we'll reflect back on 2020 and also discuss what we can expect in the new year, and especially given the pandemic and the continued challenges that our industry is facing. With me today, we have 4 esteemed panelists who have a global perspective across multiple asset classes, and I think we're going to have a lively and valuable discussion. First off, we have Jenny Chan. Jenny is the Chief Investment Officer of the Children's Hospital of Philadelphia, where she manages the investment activities for the $2.9 billion endowment. Prior to joining the Children's Hospital, she served as a Senior Investment Officer at the Doris Duke Charitable Foundation. We also have Tammy Jones. Tammy is the co-founder and CEO of the Basis Investment Group. Basis is a commercial real estate investment manager, which is focused on both debt as well as structured investment opportunities. Basis, it's also important to note, is a certified woman and minority-owned business. And Tammy and her team have successfully closed on nearly $4 billion in new debt and investment since its founding a short time ago. We're also pleased to have Roger Sitt with us. Roger is the CEO and Global Chief Investment Officer for Sitt Investment Associates, which is a diverse financial asset management firm with global investment capabilities. Roger graduated with military distinction from the U.S. Air Force Academy and sits on a number of boards, the most important of which is AIM, because Roger serves as an honorary board member for our organization. And finally, we have Gragmatics. Greg is the head of Global Manager Research for the Wells Fargo Investment Institute. Greg's team is responsible for overseeing over $500 billion in assets, and their team is importantly responsible for the screening selection process, as well as just overseeing all of the money managers which get onboarded throughout the Wells Fargo investment platform. So Greg has a lot of insight into the investment world and kind of the challenges and opportunities that money managers are taking advantage of and maybe hiding away from in the years to come. With that, we're going to start off our discussion, and we're going to segment it really into 3 different categories. First, we're going to reflect on COVID and some of the early challenges and opportunities that the pandemic has presented. We're going to then move to ESG and diversity and inclusion and discuss kind of how important these things might be to each of their panelists and their organizations as part of their screening and underwriting process. And then finally, we're going to conclude our discussion talking through challenges and opportunities in the new year ahead. And with that, and starting out in the COVID panel, I wanted to have each of the panelists talk through maybe the 3 biggest challenges each of your organizations faced in the early days of the pandemic back in the first quarter of the year. And Greg, maybe if we could start with you.
Yeah, thanks, Sanjeev, and thanks everybody for joining in today. I think as we sit here on the eve of getting the good news that the vaccines are starting to be distributed and cascaded out through the economy and society, it's a little bit easier to talk about this now. But thinking back to those early days of when we went to shelter in place and the uncertainty during that time, the three things that really stand out in my mind with respect to that time period was, first and foremost, making sure that the safety and health of your own teams were considered, and that was probably of paramount importance for most everybody, in addition to making sure folks had internet connection and monitors and remembering to send thank you notes profusely to your IT departments. And then quickly, our focus turned to the health and safety of our partners and our partnerships. And I think in part that explains a little bit why some things slowed down in terms of a willingness to take on new partnerships, because those relationships and that communication and connectivity during that time period was crucial to making sure that businesses kept serving their clients well. And then the third thing was just making sure that coordination and connectivity and interaction with your own teams and your partners stayed very strong. And those three things stood out. We went through a period, in the early days, March, April, thinking about the vulnerability of some of the business models for the asset management firms that we had partnerships with. So we sent out lots of questionnaires around IT infrastructure, ability to work from home, going concern issues, asset flows, making sure that the health and the soundness overall of the business that we were partnering with was also intact. And I think that gave way over time to less concern about the business themselves, but maybe a little bit more around individual products that some of these firms may sponsor. And so some strategies disproportionately, I think, were rewarded during this time period, and others certainly were hurt. And so I think in the end, we'll see a change in the mix of some of the offerings of a lot of these firms, but probably not quite as much M&A maybe as we expected in the early days. So that was kind of our journey, Sanjeev, on that front.
Thanks, Greg. And you each come from different backgrounds, obviously, in organizations of different size and scale, and in different places within your own evolution. Jenny, maybe if you could talk through some of the challenges you faced at the hospital.
Sure, thank you. So I would certainly agree with everything that Greg has said. I think the multiple levels of challenges that we all experienced at the global and let's call it national level, community level, then within our organizations, and then teams and individuals, where we really didn't. I mean, as far as anyone I spoke to, model for this type of scenario. Even though we all felt quite prepared for working remotely or being able to continue due diligence, I think it was, the simultaneous impact of these multiple challenges is a unique situation still, I would say, especially now as there have been, as we all know, more rules put in place in our communities. So, in addition to all the things that Greg mentioned, I would say that it was also a great test in many ways of our partnerships and how our managers and other partners reacted to something like this, and how they were also thrust into the situation where they were required to really deal with the many things that came up from their clients. So I mentioned kind of consultants, but also our managers, at once, and how they juggled that. I think that certainly there were some folks who did it exceptionally well. I would say, generally speaking, in our experience, most of our managers reacted quite well to that. Thankfully, but I think it's still, when you have a shock to the system like that, it's often or sometimes easier, I guess I would say, to react in that moment. And it's really now, and then months, from when I think we all went into lockdown in March, that the resilience really shows through. And that's that can often be challenging because I think we're all exhausted and we've got Zoom fatigue and all of these things.
Yeah. Now, thanks, Jenny. Tammy, how about you? How did you guys deal with things early on?
Thank you. So first of all, thank you, AIM community. I'm so delighted to be here and to have this discussion. So when I think about COVID, I think about the date March 13th. That's the last day that I had my team in our office in New York City. And one of the things that I think we can all benefit going forward is from the experience of this. And in New York City, we actually had Hurricane Sandy, which shut down the downtown for like 6 weeks. So we were out of our office for 6 weeks. And so if you sort of think about disaster recovery and business continuity, we sort of went into that triage mode. Getting people home and keeping them safe, as Greg said, was priority number one. But also thinking about how we were going to continue. And we actually had a dry run with Hurricane Sandy, again, different, but a crisis that we had to respond to. And then finally, it was about triaging our investment portfolio and trying to go through and look through our portfolio for the most volatile and vulnerable property types, i.e. hotels, some retail, basically going through so we could communicate with our investors. And the one thing that I will tell you that was different about this crisis than the great financial crisis, then Hurricane Sandy, then all of them, was that we were all in this together. Everybody felt like they wanted to try to find a way to get together. And I will tell you, yes, I have Zoom fatigue now, but I had Zoom acceleration then, right? We were all forced to use the tool. And I feel like, at least our firm, and I'm thankful and grateful for this, did not skip a beat. We were able to close deals, continue to talk to our investors, manage our portfolio, and do it really, really effectively. So that is something that I think hopefully most of us have that experience, and that's a surprise because I was not on Zoom prior to this crisis in any meaningful way.
Thank you, Tammy. Roger, what about yourself and investments?
Yeah, the comments that Greg, Jenny, and Tammy made, I share all those struggles and as a public securities, we focus on marketable securities, both in the equity and fixed income. So certainly keeping the client communication channel open was essential because we're the client's very liquid assets. And so we had to make sure we were able to operate, even though we had to shelter in place. We had to reduce staff because being essential services, we were allowed to have some staff in the office to make sure we could communicate and give our clients comfort that they could access their funds if they needed to. Second, the safety, keeping everyone safe was also critical, not only when everyone had to shelter in place, but when we were allowed to start returning back to the office, because the protocols that had to be implemented were crazy. And I don't know how it is in your states, but in Minneapolis or Minnesota, don't tell my governor this, but our governor was fairly vague in what was appropriate and inappropriate. So it left a lot to our own interpretation. So making sure everybody stayed safe with the new protocols was also very important. And then third, as a marketable securities, public securities manager, our time frame is much shorter in terms of, the securities. And, at the end of every day, we get to measure how well we did or how poorly we did. And remember, from February 20th to March 20th, the markets went down over 35%. And that's our clients' liquid assets. So we were, scrambling to figure out what we needed to do in the immediate term for our clients to make sure that they had their funds available and liquid and hopefully not depreciating if they stayed long enough. So.
Yeah, thanks, Roger. And, maybe Tammy, I want to come back to you because you did just talk about, the fact that you were still able to figure it out and continue to transact and get things done on the investment side. But,
Yes.
We work in an industry where, you like to meet with people, you like to go to dinner with people, you're entering long-term partnerships when you deploy capital and entrust it with money managers. How does it work in a world where you can't meet people or underwrite groups that you may have never actually had a face-to-face interaction with? Tammy, maybe we'll start with you, and Jenny, if you have a view on that, maybe we'll follow up with you on that.
Yeah. So for us, as an investment manager, we're about deploying capital. I'll tell you two things that we did. One, to make sure that we had a strong balance sheet and we had reserves. And then the second thing was to, and thankfully ensure that we had modest leverage. That allowed us to have dry powder to invest. And in crisis and challenge, there's always opportunities. Now, when you think about what Roger just said about certain platforms having margin calls and having liquidity issues, that creates situational distress. And platforms that actually had dry powder were able to capitalize on some of those opportunities back in March and April when things were just a mess, right? And so how you do that is obviously we have a national platform, so we have people all over the United States. So being able to inspect real estate by car was something that we would do. We were able to meet with our investors via Zoom, and again, everyone's trying to figure this out at the same time. Sharing due diligence information. The one thing about technology, I think we've been accelerated by what a decade Bill Gates has said with using this sort of Zoom technology, as well as all of the technology that exists to have access to comps for real estate, have access to various databases, being able to stress our analysis. We already had access to through our VPN, all of our models. And so we were able to do our jobs. Yes, you want to be with people. And we are in a business that is relationship focused, even, the investment businesses. But I think all of us had to try to figure out how to be nimble. We're also people that have to adapt, and you have to figure out, how do we get access to investments that could make sense, long term. And we were able to inspect the assets, underwrite them, get access to comps, do our downside analysis. And so, we actually in COVID, we put out about 200 million so far. And we've been very selective. It's not like we're rushing out and doing, investing in anything that comes our way. And I think that's another lesson in COVID is to make sure that you are thoughtful and careful. But there were some opportunities that, based on just how this unfolded, that were significant, that we knew were too good to turn away.
Oh, that's great. Jenny, how about yourself? Have you had to change anything or slow things down or speed things up as a result of how you underwrite?
Yeah, I would say all of the above to some extent, but I think it's always our responsibility to use all the tools that we have and the advantages that we have in managing our portfolios or investments. And so this was really the chance to test that. And when you don't have the freedom of everything that you consider normal and required, I would say in the past, you have to readjust and course correct and figure out what your actual requirements are. And are you able to deliver in the same way that you could before when you have these limitations? And that's really just, that's kind of, that comes back to whether you have the right team in place and the skills in place. But also I would say too, something that helps that is we really didn't have to change our pipeline of names or the conversations that we have, because we always start these conversations well in advance. And so even though we're 8 months or so into this, it hasn't affected our deal flow, if you will, very much. And I think it actually has helped it in a certain sense, because I've found that managers have really had to step it up, and the ones who have done that successfully are getting the time in front of us that maybe they actually wouldn't have gotten because we had this freedom before. And I would also just say that while video conferencing is absolutely great, conference calls worked well before and they work well now. So let's not underestimate, let's not throw that option out the window, because I think a good balance, like in most things, is helpful.
It's like the 80-20 rule. For every 80% of Zoom you're on, you should mix it up and go old school. Roger, when we look back on 2020, we're 30 days away from the end of the year now. Do you have a sense of new investment activity for your firm? And Greg, I'm going to ask you this question also in terms of what you guys have done at Wells. Is it going to be COVID adjusted, or did things normalize and you hit plan, if you will?
Well, okay. In terms of from a public securities perspective, if you take a look at the equity asset class versus the fixed income asset class where we focus, I think there definitely are opportunities within the marketable securities equity side of things. As the fixed income rates are so challenged right now, and the Fed has made it perfectly clear that it won't be any earlier than 2023 that they even think about moving the needle on rates. And so, individual investors as well as institutional investor clients need return, and that they're going to be forced into the equity market. But in the same light, I'm not bearish on the equity markets. I'm bullish on the equity markets, because if you see the landscape in front of us, on a rate of change basis, I think things are actually getting better. We have 3 companies that have a vaccine that's very close to going to market. We have a Fed that is backstopping things here. We have central banks around the rest of the world that are backstopping and ensuring we don't go into a recession. We have governments around the world that are implementing a lot of fiscal spending to help things out. And so there's a lot of opportunities. And then if you also look at valuations in dividend yields of stocks versus bonds, there's a lot of opportunities there. And over the last several years, you've had a shift into a lot of fixed income, and I think you're going to see a shift back into equity. So it's actually a fairly bullish environment for the equity market going forward. Now, with that said, we've seen a handful of stocks, and I'm focusing mainly on the FANG stocks: Facebook, Apple, Amazon, Netflix, and Google, plus Microsoft has really accounted for 75% plus of the appreciation that we've seen in, say, the S&P 500 right now. And going forward, I think the market will broaden, and the rest of the market is not as expensive as those handful of stocks I just highlighted.
Sure. Greg, what about you in terms of what you're seeing at Wells Fargo and what your clients are doing?
We largely agree with Roger's view on that. I think we expect a relatively uneven recovery to start to gain momentum and take hold and broaden out as we progress through 2021. Our forecast for global GDP for next year is 5.2%, and here in the U.S., we expect GDP to be around 3.8%. So that's significantly up year over year. And to Roger's point, I think the year-over-year earnings forecasts are going to, be eye-popping for a lot of people. And so the question is, how do you get positions to take advantage of kind of the new themes coming out of the administration and the light that we're now starting to see at the end of the tunnel with respect to the eventual winding down of the pandemic due to the vaccine distribution. So I think investors are excited to be back active in the markets and looking at positioning their portfolios. So I think there'll be a lot of opportunity in 2021. On the inflation side in the US, we see that being relatively mute, although picking up from about 1% to 1.7% for 2021. We see the dollar continuing to weaken, which will help US businesses. And so I think what will be probably the most important differentiator for active managers next year will not to be to decide which businesses exist and which ones don't in 2021 and beyond. It's which ones exist and what does their new business model look like vis-a-vis what the consumer and the business spending patterns are going to be going forward. I think it will take a bit longer for the spending patterns to come back than people are expecting. But nonetheless, I think they are going to come back. There's going to be a lot of pent-up demand. They won't be in exactly the same places. And if you're an active manager, you're going to want to look at those harder to figure out spaces in order to try to differentiate yourself. The trades where it's relatively straightforward and sorting itself out is going to be a beta trade, and you're going to overpay for that. So it's going to be wading into those industries and those spaces and those business models that have yet to really kind of find their path forward, and really do your homework there and make selective investments around those themes to really stand out in 2021. So again, I think we see the market, at least from the S&P point of view, being up again, and the quest for yield, for infrastructure, continues to alternative energy based on the climate change theme with the new administration to be pretty popular ideas right now.
No, thank you for that. Oh, go ahead, please, Roger.
To add to Greg's comment too, is the market is an anticipatory mechanism too. So even though, like, our personal view is that the economic recovery is not a K recovery, not a V, not a U, but we're calling it a Nike swoosh. So it's going to do a V shape off the bottom in the third quarter, but now the slope on the backside is very gradual. But with that said, if we're right, and in terms of rate of change improving, and in terms of the outlook, the market is going to anticipate that, and the market tends to anticipate 6 to 18 months out, and so that's why you're seeing the movement in the market.
No, thank you for that, Roger. I wanted to move the discussion along to the second category around ESG and diversity and inclusion. And, if we look back on all of the, quite frankly, the horrific events that we've seen in this country and around the world, I think it has shone a light on creating opportunity or the lack of opportunity for certain segments of the community. We've tried to highlight some of that with some of the earlier discussions with Professor Lerner and the discussion he had with Brenda around the Beller research as one input to that discussion. But when you look at where we are, like as an industry in 2020, and you look at the types of allocation decisions that your organizations are making, how important is ESG and diversity and inclusion to your underwriting process when you're entrusting managers with capital? And Jenny, I wanted to start that with you, and then Greg, maybe move to you, just because I know a lot of what you guys do is screening and researching managers before they get put up on your platform at Wells.
Yeah, so this is really an area that I'm personally quite passionate about and have had deep experience in my prior organization. But I think it's really important to recognize that each organization comes to this at a different level. And so currently at CHOP, we're spending a lot of time on this and trying to figure out really how, in what ways, using integrating ESG into our due diligence process is a reflection of our mission and values across the enterprise, and also where diversity, equity, and inclusion plays a role. And I would say we're early in this, and I think the prior panel touched on some of these themes. A lot of what's really important is consistent data gathering, and I hear that from all the conversations that I'm having. So that's going to be a critical piece of really moving the curve. But I would also put this challenge out to everybody as an individual, is that we have very high expectations of ourselves performance-wise and on an accountability level, and that shouldn't stop when we talk about diversity, equity, and inclusion. And so really, some of the progress that I've personally been through this year is reflecting on what that really means to me. And as a decision maker and allocator, what is the right role and the area where I can have the most impact. And so that's not an answer. And I think, if we were all to convene again next year, I'd like to have more concrete parameters around that. But, the idea of this individual accountability, I think, is a really important one.
Thank you for that, Jenny. And Greg, I mean, just kind of given the lens that you have and the insight that you have, how important or how in the conversation is ESG and D&I when you're underwriting and screening managers for your platform?
Well, the approach we've taken at Wells Fargo with respect to ESG is to evaluate 100% of our recommended list through a 5-tiered classification system around the level of ESG integration actually in the process. So we're not changing the overall rating necessarily based on whether they are integrating it or not, but we are publishing quite transparently for our investment professionals an evaluation of whether or not a manager is actually an ESG manager or not. We've seen an explosion of the popularity from an asset gathering point of view with respect to ESG. And I assure you, putting a redwood tree in your prospectus does not make you an ESG manager, right? And so overnight, a lot of firms have started talking about ESG, and some are actually doing it and some aren't. And so our first foray into this has been to make sure it's very clear for our investment professionals as they meet with families that are looking to express certain values and positions in their portfolio that's understood, and which managers are well suited to serve that sort of mandate for clients. On the D&I side, we've been at this for about 6 years now. And we've done everything from, listening tours to symposiums and speed dating rounds where we invite in a bunch of what the industry more broadly calls emerging managers, which is a term that I don't particularly care for myself, but managers that are looking to diversify their client base into new avenues, new channels. And we've got a ton of work left to do there. We're still talking past one another, I think, to a large degree. It's being misunderstood as some sort of institutional bias, but in fact, I think there's many other explanations that are causing that. And the least, or not the least of which, is having a true message for why you should use a diverse manager. So the most common theme today is, well, because it's the right thing to do. Of course, it's the right thing to do, but people don't want to perceived trade return or increase risk sometimes to do that, right? So I think the next level of messaging that is resonating, and this is picking up tremendous speed this year because of the social unrest, is, hey, I want more managers that look like me and my family managing my money. And so we've created lists of managers along 5 different diversity dimensions that we publish for managers that allow us to disclose that information, so our investment professionals have that information. But I think that the crucial third piece of this is to make sure that there's an investment rationale for making the inclusion or the allocation. And here, we talk a lot about diversification in our industry, a security, sector, geography. But I do think in a diversity of background, a diversity of perspective, a diversity of thought is an important consideration in portfolio construction. And if we are talking about legitimate reasons to do this, I think we need to move beyond it's just the right thing to do to putting money in investors' mouth where it really matters to them, and let them know that there's a level of diversification here that matters, that needs to be considered as part of this. So having the investment rationale as well as it's the right thing to do are 2 important messages. So on that standpoint, Wells Fargo's begun publishing spotlights on our diverse-owned firms that talk about the firm's background, their journeys in terms of the portfolio selectors, security selectors, as well as their investment performance, trying to put a bigger spotlight on the fact that you can create differences in backgrounds and perspectives on folks that are managing your wealth to add additional diversification and not have to give up any return, and arguably in some cases even enhance it. So, that is picking up steam. We're just in the early innings of making those sort of arguments more forcefully across the industry. But I think in the end, we need to move beyond where we've been stuck with, we need to be fair and give access. Yes, of course, that's part of it. But we need to respond to the other needs, I think, to really hook the trains.
So can I just chime in?
Yes, please. Tammy,
Okay,
I wanted to go to you.
So I think that study after study shows that diverse teams produce better outcomes. There's the Knight Foundation studies, there's McKinsey studies, there's Bella Research, there's study after study. And I will tell you that what is the most frustrating thing for me as an African-American female-owned investment management company is that even with these studies, we still have allocators pushing back and saying that there's more risk with diverse managers. And I would love to see a study that even shows us that our returns are lower. There is no study such that exists like that. And so I think it's really important that you're right. It shouldn't just be about diversity matters, diversity of thought is good, and it's the right thing to do. But there's also a reason to find alpha. There's also a reason to try to find niche strategies and look at the returns. And so what I'm encouraging all LPs to do is to make sure that you have those studies. So you see that it's not about risk. There is a perception that diverse managers are more risky. And it's just not right. It's just inappropriate. My returns
Tammy,
are just
I think, yeah, I think.
Let me finish.
Sure.
I'm going to back over to you. I think it's important to have this dialogue and we can be, we can agree to disagree. What I'm saying to you though is that when we say that we need to have more data, the data has been here for years. We just need people to actually start to believe it. And that's the thing that, I'm the chair of Real Estate Executive Council, and we are out there talking about why diversity matters and why it's important to look at the performance of diverse teams and not just make the assumption that the performance is worse. And that's all I wanted to say. Greg.
Yeah, and I agree with you on those, the lack of the awareness around those studies. We all know the modern portfolio theory papers from Bill Sharp and others in the business, but these studies are not very well known. So your point's well taken. As an industry, I think we can all do a better job promoting a greater awareness of those findings. But when it comes to the discussion of risk, you often equated that with loss of return opportunity. But I assure you, that's not the only risk that people are thinking of. This is where part of our 6 years of learning, and we've got more journey to go, has indicated to me that there's a dialogue on both sides that needs to happen. So there's operational risk, there's organizational structure risk, there's trading infrastructure that needs to exist to hook up to some of these retail programs, and on and on and on. So I think when we talk about risk, we're not talking about opportunity cost of A outperforming B, but we're talking about the entire package of the firm and its preparedness to be able to exist in the channels with the best practices standards that exist. So I think, you know, if we're just focusing on performance, I think we're missing some of that dialogue in terms of what gatekeepers are getting hung up on, I guess.
I think it's important. Sorry, Jenny. I think it's important for all of us to be educated, right? Like you have to have access to research. As an allocator, you have to be informed. You have to actually do the work, right? It seems like we're all kind of talking around that, but as an industry group, that's something that we at AIM are trying to do, and I know our sister organizations are also doing the same. In the interest of time, I wanted to move the discussion along, and we'll have maybe time for a little bit of Q&A. But as we look to 2021 and the new year, if each of you, and Roger, I'm going to start with you and Jenny, if you could just think through very succinctly, what do you think is the biggest opportunity from an investment standpoint? And if there's one area in particular which you would avoid like the plague, no pun intended, investing into, what might that industry look like?
Well, I think I mentioned earlier that I am very positive on the equity markets, and that's because I'm positive on the economy going forward in terms of recovering from where we are now. And of course, that leads to stronger corporate earnings. But I think it's also important to recognize that there'll be the haves and the have-nots, as Greg highlighted earlier. And so I definitely think there'll be a broadening in the marketplace. I think that what we've seen happen with this whole COVID crisis is that we've seen an acceleration in certain trends, such as the work from home trend, such as, cloud, such as online delivery and all that. And they were trends that were occurring, but they've been accelerated, and we're not going to turn back. So investing in, some folks call it new economy type of stocks, whether it's in the technology sector, health technology sector, such as online teledoc or whatever, is from an equity market perspective is where you want to be. Some of the older economy stocks, where it's been shown, that there are certain jobs. I think every company you go into, whether it's an investment firm, a law firm, a manufacturing firm, you figure out where your excess slack was, and you're not going to need that. And so in terms of investment, some of the older economy type of sectors is where you want to stay away from, as well as I commented earlier, it'll be challenging for fixed income.
Thanks. Sorry. Thanks, Roger. Jenny, how about yourself from Chop's perspective?
Yeah, I know we're quickly ticking down. So agree with what Roger has said, agree with what Greg has mentioned about, the opportunities with solutions to climate change. I would say also, landscape for healthcare and biotech has changed in a way that we haven't seen historically, where there are always going to be big divisions between winners and losers. And I think there are less compelling opportunities. So for us, even though there will be, periods where I would say public natural resources will do well, we decided to get out of that, and it would be very hard to get back into that.
Thanks, Jenny. And apologize. We're running through our time. I did want to just ask Tammy if you, in 30 seconds, could.
Yeah, 30 seconds. I'll go for it. So affordability crisis in America. So workforce housing, multifamily. I'm a bricks and mortar girl. I would say life sciences, significant opportunities, data centers, last mile industrial.
Thank you. I appreciate that. And thank you to each of you for the discussion. I'm sorry we're running a little bit short on time.
Thank you.
So that brings AIM's final virtual event for 2020 to a close. Hopefully you all enjoyed the lively discussion we just had on this session, but also found informative some of the topics we covered earlier in today's session. We hope, I'm keeping my fingers crossed, we hope to see you each in person live in a more traditional format next year. Our annual conference will be in September in San Francisco, so let's all do our part and stay safe. And in the meantime, let's hopefully all stay connected. Appreciate your engagement with AIM, and wish you all the best this coming holiday season. Thank you.
Thank you.
Take care.
Thank you.
Bye-bye.
Bye.